Welcome to the Deep Dive. Today we're jumping straight into the huge realignment happening in Oregon's commercial real estate market.
We're looking at sources that define what's being called the Great Valuation Reset of, well, right now, November 2025.
And our mission here is simple, to get to the core of what's driving this massive structural divergence in the market.
I think we have to start with the most shocking deal.
The U.S. Bancorp Tower.
Big Pank.
That sale, it wasn't just about setting a new price. It really signaled this essential moment of market capitulation.
Capitulation. Explain what you mean by that.
Well, you have a tower that was valued at over $370 million back in 2015.
Okay.
And it just sold for $45 million.
Wow. If you break that down, what does that come to per square foot?
You're looking at roughly $40 per square foot. That creates a new and frankly devastating floor for downtown Portland assets.
$40 a foot. That's just... It's hard to even imagine. But you're saying this repricing, as painful as it is, was actually necessary. Exactly. The market was completely frozen. Sellers had their hopes, buyers had their realities, and nothing was moving.
So this unfreezes it.
It unfreezes transactions, and more importantly, it's starting to attract a very specific kind of capital. High net worth private investors who are totally comfortable operating at this new, lower basis.
Even with downtown vacancy being cited at, what, almost 35%?
A staggering 34.6%, yeah. But they're buying generational assets for pennies.
Okay, so that's the downtown story. Pain. But a key takeaway for you is that this pain isn't being shared equally across the board.
Not at all. It's a textbook bifurcation.
Yeah.
You have the central business district, which is just hemorrhaging tenants. Q3 saw 410,000 square feet of negative absorption.
Meaning people moving out.
Right. But then you look at the suburbs, and it's a totally different story. Submarkets like the Sunset Corridor, Cruiseway, they posted over 260,000 square feet of positive net absorption.
So that's the flight to quality and safety we keep hearing about. Companies are prioritizing newer, maybe campus-style suburban buildings.
Absolutely. They are ditching that old, expensive core space for resilient, quality suburban space. That trend is here to stay.
Let's shift to industrial, because that seems like a bit of a paradox right now.
It really is.
On one hand, the huge logistics boom from the pandemic has cooled off, so there's some negative absorption there.
True, but that's being completely overshadowed by what's happening in Hillsboro's Silicon Forest.
Data centers.
Data centers. It is rapidly becoming a premier hub, and this is driven almost entirely by the massive ongoing need for AI computation.
And what's interesting there is that the main constraint has shifted, right? It's not about land anymore.
Correct. It's no longer about finding space. The real bottleneck is power. Getting enough electricity and then navigating all the environmental compliance needed for these incredibly energy-hungry facilities.
So if industrial is a paradox, multifamily feels like it's just staring off a cliff.
A guaranteed supply cliff. This is the critical pressure point for the next few years. It raises some really serious questions about housing in the state.
How bad is it?
Construction starts have collapsed to a 10-year low. We have only about 2,000 units currently under construction. That's for the entire metro area.
2,000, that's nothing. So how fast does that translate to, higher rents for people?
It's going to hit hard in 2026 and 2027. You can pretty much guarantee a severe supply shortage, which means significant rent hardening. Any relief tenants felt is about to go away.
And on top of all that, there are these major regulatory changes. There's a stick and a carrot, it seems.
A very big stick, yes. The new Oregon Building Performance Standards, the BPS.
Right, demanding rigorous energy tracking, and that's starting, January 2025?
It is, and it immediately creates what we call the Brown discount.
The Brown discount.
Older buildings that don't meet these new standards, they're now selling at a discount because a buyer knows they have to pour in significant capital capex just to get them compliant.
That sounds like a big disincentive. But there's a positive counter lever you mentioned. A carrot.
That's House Bill 3746. It shortens the liability window for construction defect claims from 10 years down to 7.
Which should mean lower insurance costs.
Dramatically lower.
Yeah.
And that could be the thing that finally reignites the for-sale condo market, which has been basically dormant for years.
Okay, so wrapping this up for our listener, what's the bottom line? It sounds like the worst of the pain is over, the deck has been cleared.
I think the initial bottom is in, yes.
Yeah.
Valuations have found a floor, especially in multifamily, where sales volume actually jumped 34% year over year. There's stability.
But there's a bigger, lingering question here.
There is. The commercial growth of the state relies on stable demographics, and that ground is a bit shaky. The median home price in Portland is still around $600,000.
And population growth is an issue.
A huge one. Our sources point out that Oregon's entire population growth is now projected to come just from net migration. Deaths actually outnumber births statewide.
Which leaves us with a final thought for you to consider.
Exactly. How does this total reliance on, let's call it wealth migration, paired with a housing market that's prohibitively expensive, how does that impact the long-term stability of the workforce you need to power this whole commercial engine?